The European Central Bank managed to have a bit of an impact on the markets today by making clear that it's taking a dovish view of the world and stands ready to do more QE if needed. But the real anticipation's building for US jobs figures tomorrow, as Payrolls Friday offers another chance to try and figure out whether the Federal Reserve is actually going to raise rates in a fortnight's time. Now, the really interesting question for me isn't whether more or fewer than the consensus forecast of 219,000 jobs are created. It isn't even whether any Fed policymakers are likely to change their views simply because of a single stronger or weaker payrolls figure, which after all covers just a single month and has a margin of error of about 100,000, far bigger than the usual beat or miss of the consensus. Instead, the interesting question is what it tells us about the state of the market. Would good economic news also be good news for the markets? Or perhaps bad economic news would be good news for the markets? Is a stronger US economy a solid support for equities? Or do higher rates and a stronger dollar threaten an emerging market crisis which would have spillovers back into developed countries? Market sentiment swung between these two views since investors last month woke up to the problems that China faces. One of the simplest ways to look at this is through the dollar itself. In the years after the financial crisis, the dollar was a haven currency. It was sold when people were feeling good and bought on bad news, both about the economy and the financial system. Now, this shows up particularly well in the correlation with shares. There was a solidly negative correlation between the dollar and the S&P 500 from 2009 right up until 2 years ago. You can see that this is the zero line, so anywhere below here means that the dollar and shares move in opposite directions. Now, as the Fed began to pull back from special measures and taper its bond purchases, the dollar flipped to become a growth currency. That is, good news meant that the dollar went up and share prices went up together. Or had a tendency to. So the correlations were positive. They became particularly positive, above 50% at the start of the year. Now, that, I should say, is only a measure against other developed countries. So this is the dollar index, which is a measure of the dollar against a basket of American trading partners in developed markets. It doesn't include any emerging markets. Now, there was a big reversal earlier this year when US shareholders began to worry about the effect of a strong dollar on profits, but that passed. Recently, the correlation's been strong again. Good news on the economy is good news for the dollar and good news for shares, which suggests little fear of higher rates. But if we include emerging markets, the story changes. Against emerging markets, the dollar remains a haven to be bought in times of trouble. And of course, we're in times of trouble for emerging markets at the moment. Now, the dollar against the developed countries here in blue, what's called major currencies, very similar to the previous one, which is a basket of American trading partners in developed countries, whereas the red line, the other important trading partners, is a measure of the dollar's value against emerging markets, including China. And I put US stocks on there too in green. Now, the contrast between the two, how the dollar behaves against those two baskets of developed and emerging countries is particularly obvious in the recent equity plunge. The dollar fell back against developed countries. You can see the blue line coming down at the same time as shares were falling. But against emerging countries, the dollar rose very, very sharply as that was going on. The opposite then happened as sentiment turned positive again. Shares bounced, the dollar bounced against the euro, the yen and other developed economies, and the dollar fell back against emerging countries. Now, if jobs come in particularly strong, it's certain that traders will see a Fed rate rise as more likely. Now, that in turn ought to be good for the dollar. But beyond that, it all depends on sentiment. Will positive feeling about the US economy outweigh increased fear about emerging economies? Equally, seen the other way round, if we have disappointing jobs figures, could that be seen as good news or bad news? Well, again, it comes down to the question of whether how much we care about emerging markets against how much we care about the US on its own. Now, my guess is that it'll be seen as positive news if we have positive news on jobs, but the glass could equally well be taken as half empty as half full. It isn't enough for traders just to predict accurately what the jobs figures will be. They also need to make a fine judgment on the market mood and how other traders will interpret them.